Gentlemen, it's great to have you both. I appreciate it. Jim, let me begin with you and just ask, coming off of the jobs number, the Friday action, the loss of the gain today, is September sledding going to get tougher or easier, do you think?
Well, there's no reason to expect the volatility to settle down here. There's great uncertainty around what the Fed is going to end up doing. You've got real economic challenges in Europe and in China. The U.S. is the kind of lone bright spot, if you will. So I wouldn't expect a downturn in volatility over the near to intermediate term, Carl.
Right. Jordan, even if we get through some of that chop, is your general view that Q4 is going to end the year on a brighter note rather than darker?
Well, I think we could enjoy a bit of a December Santa Claus rally, if you will, in the markets. But I think we got to get through the elections, the midterms. So I think the markets are going to be very, very choppy through November. Seasonally, September tends to be a challenging month for markets. And I think the markets are already sort of appreciating a bit of a slowdown in the economy, potentially hitting sometime in the first half of next year. So, again, I think it's going to be a choppy market, again, at least until the elections. Once that cloud of uncertainty sort of clears up, I think we could enjoy a bit of a late end of the year rally.
Jim, what do you think is responsible for today's sell-off? Is it the fact that U.S. investors are finally starting to pay attention to a potential crisis brewing in Europe, given what's gone on with the slew of headlines over the weekend and this morning surrounding their energy situation?
I think that's part of it. One of our key risk cases is what we're calling Eastern threats, and that's around the risk of Russia and Ukraine with gas supply into Europe. But it's also very importantly tied to the difficulties in China with their zero COVID policy and without a world-class vaccine in place. The risk around China is that we're going to be running through this for the next 12 to 18 months. So I really think it's a combination both of the weaponization of energy in Europe and also the lockdowns going on in China.
Jordan, if we can expect some chop between now and the midterms, as you mentioned, what do you think is the best way for investors to play this, given that we've seen a portfolio, your typical 60-40 portfolio and deeply in the red this year? Is it best to just kind of sit on the sidelines in cash, or are there other types of potential hedges that investors could be pursuing?
Yeah, I think investors have to remain broadly diversified and balanced. We certainly have a preference for U.S. markets. We have a preference for large cap. And if I'm putting new money to work, I'm probably putting into in a large cap core type of strategy to play both the value and growth side of things. We've already had a pretty meaningful correction in markets. While markets may be choppy, we could have short-term stints where markets perform particularly well. I know we're on a downward slide now, but that could always change, particularly if we have call it white swans, if you will, some positive news in terms of lockdowns in China, in terms of the energy crisis happening in Europe. So there could be some positive data that we get from a global standpoint, but I think markets are recognizing some more of the challenges that we're seeing, particularly this morning.